All right, everybody, welcome back to the channel. It's Millennial Trades. Choppy market action today. It almost looked like Santa was going to come through today for us. You had the indexes rallying, both the NASDAQ and the SPY. I was watching the futures. We kind of dipped a little bit in the morning. I'm looking at it right now, though. We got this nice little rally. Amazon, PayPal, Square, a lot of the stocks that I've been following rallied along with the market. But then we came right back down. So we started chopping around a little bit. The NASDAQ was even making some sort of wedge, or I think it was like an ascending triangle type of pattern. And it looked like it was about to break out, and it didn't end up breaking out. This is the thing with the stock patterns, which is why I don't put too much into them when I see them, because they fail all the time. They probably fail like 50% of the time. Maybe back in the 70s when technical analysis was kind of an elite thing, a secret knowledge, it might have worked. But I'm not sure if technical analysis, especially reading patterns, if that's the only reason you're taking the trade. In my opinion, it's a bad reason to take the trade. Just from my experience, some people, maybe it works. I know a lot of people in the over-the-counter penny stock markets that are trading those kind of things. A lot of them swear by patterns. They say the patterns still work. But I don't trade penny stock, so I wouldn't know. But yeah, looking at some of these technical patterns, even some of these bullish breakouts, just to see them come right back down. So overnight, I was holding, I think it was the $86 calls that expire 2 weeks from now. I was up on those, and I was up big, so I took my profit soon after that morning rally. I also scalped my way up with the $88 calls that expire this week. And we had a supply zone right there at like 86.50, and that's when I pretty much just took profits because we were chopping around. I didn't think we were going to break that supply on Amazon, and we didn't. So there was some bearish news here for the markets, right? You had retail sales in Canada, especially for things like Amazon. Retail sales in Canada had contracted a little bit. You had the housing starts, that were down again. Obviously, the monetary policy is causing a lot of drama. People are the economic numbers too. The economy slowing down, the services number, the manufacturing number, all of this stuff I think is still weighing on the market. Will we see that rally this week? It's looking like maybe, but again, maybe I could have held my calls and see what happens tomorrow. But I was up big on them, so I just wanted to take that profit. I usually don't take overnight trades, but something was telling me yesterday just to go for it, and I did. I'm up over $2,000 today, which is, that's grand. $2,200 I think is about what I made. So definitely still trying to be on the right side of these trades, especially going into the new year, because I don't want to take any huge crazy losses. My strategy is just getting in and out. It's better to see my contracts sold out but go further than to not sell them and see them pull back, because that tends to be what happens. I'll get like too greedy. And it's not like I need to catch the whole move. I usually don't catch the entire move. You're talking about like a span over a half an hour or so. I might catch half of that move, right? But picking tops and bottoms, impossible. So yeah, the choppy market, all this economic news. We have the PCE inflation data coming out on Friday. Again, that would be hard to trade unless we're trading like anticipation going into it. If you were going to hold something overnight, perhaps on Friday you could go for the contracts that expire a week out or maybe 2 weeks from that Friday. I think I might just kind of scalp, right? Just sort of scalp the PCE data. Don't think I'm going to put an overnight trade on. Because I was actually a little nervous about my trade tonight. I just don't like holding things overnight. I don't like, especially if I'm trading, I really don't like the overnight exposure. It's unless I'm extremely confident. And I suppose I was confident enough to take the trade. But I was watching the dollar intently. This was one reason I went long on Amazon, right? Because I bought calls. And I was watching the dollar. The dollar came down in a big way. Where do we close here on the dollar? The dollar closed at 103.93. Let me see this real quick. Yeah. So we had a pretty significant down day. I was really thinking the dollar would be more bullish this week. So far, it hasn't. But if you look at the dollar index chart, I mean, a massive move down. And this is one indication that going long on calls or stocks, might work out. When you see the dollar pulling back, people are getting out, they're selling off their dollars, they're getting out of the dollar and hedging with stock. But why were people getting out of the dollar and hedging with stock? Right? It's not because the markets are strong. It's not because there's strong outlook for the stock market right now. No. There's something going on in the currency markets, and this is the big news of the day. This is what I'm going to try to articulate to you guys. I think I sort of figured it out, but it has to do with the Bank of Japan. Yes. All right. Today, Japan made some announcements on their it's called their bond yield control program. I don't exactly understand it, but they have like a range of where they let the yield go. And right now their target is 0. So their original range was 25 basis points in either direction past 0, which puts you into negative rates. I mean, just imagine that. They raised that. The big announcement, they didn't change their overall policy, but the big announcement today was the Bank of Japan was going to raise the range that these yields can go past 0. I think it's on the 10-year. I'll look through my notes here in a second. But they raised the range from 25 basis points to 50 basis points, which made the yen actually spike up. For whatever reason, the yen soared against the dollar today. We had a 4-month high against the dollar, the biggest one-day rise for the yen in 24 years. I had a guy that lives in Japan on Instagram telling me that he's actually glad to see this, that inflation has been really bad because the yen just got rocked this past year. It bottomed out in August. But with the broad policy unchanged, but still sort of, they've got the short-term yields at negative 0.1% is where the Bank of Japan has them pinned. They've got the 10-year yield around 0. They decided to let the long-term yields, on the 10-year, I suppose, maybe 10 and 30 years, move 50 basis points to either side of 0%, which is their target. And that's up from 25 basis points. So again, I'm not exactly sure how this all works. I'm still trying to work it out in my mind and do research and figure it out. But it seems to me that this has something to do with negative interest rates, but that perhaps the market isn't really buying a lot of the rhetoric from the central banks. And this is something I want to talk about here, because we talked about Peter Kazimir's statements, the governor of the European Central Bank in Slovakia. Kazimir said a couple of days ago, right? What was his quote here? Basically that, a strong restrictive monetary policy is going to be needed more and for longer, at least going into the next half of the year. And this is where we get into the rhetoric, right? Because we hear this similar rhetoric from Jerome Powell. But then you look at the yield curves here in the United States. People are willing to get into these short-term bonds as opposed to the long-term bonds because there's so much uncertainty. And with the yield curve inversion, it's inverted right now, meaning that the shorter-term bond yields are higher than the lower-term bond yields, or the longer-term bond yields, which is kind of bad because it means people don't have any faith in the long-term health of the economy, or they're not willing to place any bets on it. So trying to capture all of this in our minds and being aware of all of this, are the markets actually buying what the Fed is saying, what the ECB is saying, what the Central Bank of Japan are actually saying? Are they buying the rhetoric? And is it just rhetoric when he talks about, restrictive monetary policy going into 2024, perhaps 2025? Maybe they make cuts 6 months from now. Maybe they don't make cuts. It seems that the market, at least the bond markets, believe that because the economy is getting so bad, they're willing to place more and more bets on the longer term bonds because they just think the economy isn't, who knows what's going to happen 10 years from now. The bond market is sort of trying to price in a downward spiral in the economy. So they're not really believing Powell because Powell's telling us that, everything seems to be okay right now. Yeah, some of the numbers are coming in a little bit iffy lately with manufacturing and services, but overall, we need to slow down the economy even more. We haven't done enough. I mean, this is what Powell has been saying at these FOMC meetings. Does he actually mean it, or is he trying to front run the markets? And are the markets buying it? Because the markets are basically, at least the bond markets, are telling Powell, we don't believe you. We believe you're gonna have to cut rates sooner than this because our economy is going into the toilet. So I guess it's a matter of trying to determine how serious the Fed really is. Does the Fed really want to bring us deep into recession, or do they just want to cool us down enough and they're going to start making cuts as soon as we start dropping off? And here, another thing to consider is, even when they do make cuts, is that going to stop a downward spiral in the economy? Is monetary policy that relevant? There's a channel I've been watching, Euro Dollar University. I think his name is Jeff Snyder. This channel is very interesting. He talks about the euro dollar market and how the system and how it's bigger than just the Fed or the ECB. You got to look into it for yourself. I'll try to explain it in future videos, but it's a very interesting channel. And he proposes this question that perhaps monetary policy is not even that relevant. Do they actually control the economy in the ways that they say they do, or the way that they think they might be able to? Very deep questions here, but I mean, seeing all this going on with the currencies, this is why I need to Google the dollar or Google FX market every single morning and see if I can figure out what's going on with the currencies. Because if you can figure out what's going on with the currencies, which currencies are weakening, which currencies are strengthening, where there might be, a bull run or a bear flush out in one of these currencies, it might help you in your options trading, in your stock trading. Because, when there's good reason for the dollar to come down, that probably indicates, at least in the morning, you might see, some rallies. But again, we're chopping around here. We'll see what happens in the U.S. equity markets later this week and going into 2023. The rally is just, I don't know, guys. I don't know. We'll have to see. The NASDAQ looks, I kind of like that green closing candle on the NASDAQ futures for today. Volatility index still very, very low. And, I'm incorporating, by the way, with the yen trade, right? The dollar lost 3.9%, the euro lost 3.5%, and sterling lost 3.7% against the yen. So these were huge currency moves, huge currency trades. Maybe eventually I could get into trading currencies, but I think I need to graduate to futures first before I start trading currencies. And this is another reason options is so much less dangerous than like futures or something, because your risk is defined. If you put 500 into the trade, if you hold it to zero till the expiration date, that's the most you can lose. They can't margin call you. They can't ask you for more money. But shorting stocks or buying futures, all of this thing, I got to figure out more and probably develop more capital through options trading before I get into that. But I had a good week. I'm really looking forward to trading the rest of the week. Again, very choppy conditions, but I think if you're careful, you're in and out, and you're paying attention to the macro environment. I mean, at least from my experience, it seems to be going better than just going in blind. And that's what I was doing back in 2021. I was literally trading blind, not thinking about interest rates, not thinking about the FOMC meetings, not thinking about the dollar against the euro or any other currencies. And that just wasn't working for me. Whatever I'm doing now, because I'm incorporating news, I'm not focused so much on technical analysis or supply and demand zones. I mean, I do use them. I'll use them for confirmation. But the news, it makes predicting these moves maybe a little bit easier, right? And my success rate, I don't know, is way above like 95%. I've had two big losing trades in the last couple of months. So, and they were pretty big losses, but I came back from them. Maybe once in a while having like a loss where you wipe out 1 week's worth of gains, that might happen, but it's like, can you keep that from happening every day? I saw this, somebody turned me on to this trader. I think it's called the Trade War, right? On Instagram. He's got a website. He might be on YouTube, but I watched one of his videos and he talked about how the main thing is just staying green, whether it's $50, $500, $5,000, just stay green as every day if you can, because when you're green, you feel good, right? I don't feel good when I'm in the red. I hate having to make, my shorts or my videos, post on my stories and, down $500, down $1,000, down $1,500. I hate it, right? I told you guys this yesterday. I hate losing more than I love winning, but you can't win them all. But developing like a proficiency here, I hope you guys understand where I'm coming from. I mean, these are very uncertain times. I think this is a great, Tim Sykes was saying this in a video I was watching today. This is a great market to learn in. This is a great market to take your time and actually learn how the mechanisms work, how the market functions, how the currencies function, how the central banks function with each other. Great time to learn all of this stuff. And I'm really looking forward to 2023. That's pretty much it. The other real big news I guess I was paying attention to is still about TikTok. Governor Youngkin here in Virginia, my home state. We got Virginia Beach behind us. He banned TikTok on all state devices, so the state workers cannot use TikTok. I think they're getting ready to do this on a federal level, or maybe they already have. You have comments from the FBI and the FCC all saying that TikTok is a huge threat to national security. Some want to ban TikTok completely, not just on the state devices for state workers, but ban it completely. But how do you ban an app that's been downloaded by millions of Americans already? It seems like a very hard feat to accomplish. But what do you guys think? Should TikTok be banned on state devices, federal devices, or should they go further and ban it for American consumers as well? I would love to hear back from you guys on this one. And let me know what you guys think about the Japanese interest rates going into the negative and affecting the dollar. Did you guys see this? Do you guys understand it? If there was anything I missed, please inform me. Comment down below. Give the video a like. Follow me on Instagram at Millennial Trades. And as always, until next time, I'll see you on the next video.